4:30. Okay, welcome all, clients, prospects, advisors, and partners. A special webinar here today so we can catch up about what is happening in the global economy, but most importantly, what's happening in the UK economy, and with a particular focus on the pound. So I've got a very special guest joining us in the early morning from the UK. We've got Matthew Ryan, our Chief Market Analyst here, and thank you for joining.
Yes, thank you very much, Nathan, and thank you everyone, and welcome to our webinar.
So most, for people that are on the call right now, you'll be able to ask questions in the little Q&A box at the bottom. Feel free to put your questions in there throughout, and at the end we'll leave time to get through some of those questions. I'm sure with everything happening in the UK economy at the moment and all the news coming through daily, that there's plenty of questions to ask and but plenty to be gained from today's session. So I'll hand over to you, Matthew.
Great, thank you very much, Nathan, and yeah, again, thank you everyone for joining and welcome to our latest webinar. As Nathan said, we're gonna focus mostly on the UK today, but I'm going to cover a little bit about the sort of global outlook we're seeing in the FX market at the moment. It's been, well, to say it's been a volatile period in financial markets in general would be a bit of an understatement. We're seeing spikes in volatility among many of the major currencies amid a number of downside risks to global growth. Central banks continue to raise interest rates at an aggressive pace. Markets are concerned about potential energy crisis in Europe. We started seeing a bit of a deterioration in global economic data. That's hit risk sentiment and supported the likes of the US dollar. So we'll talk about that in our sort of global summary. I'll then move on to focus more on what's going on in the UK, obviously focusing on the recent budget announcement from a few weeks ago, and how that has impacted sterling, and what the latest developments that we've seen in the last few days mean for the pound. I'll then give a sort of brief overview as to what our expectations are for sterling against the Australian dollar, and then, as we said, there'll be time for questions at the end. And as Nathan mentioned, if you have any questions as we go through, please feel free to pop them in the Q&A section, and we'll get around to answering those at the end. So as I said, I'm going to start by giving a sort of global outlook and talk about some of the main factors that are driving markets in general before we move on to sterling. And as I said, volatility has been particularly high in the foreign exchange market in the last few weeks. What is driving this volatility? Well, first of all, we continue to see most of the major central banks raise interest rates very aggressively. The Federal Reserve in the US has very much led the way, and looks set to deliver another 75 basis point interest rate hike at its next meeting in early November, having done so at each of the past few meetings. In fact, every central bank in the G10 is currently engaging in a pretty aggressive hiking cycle, with the exception of the Bank of Japan. We've also seen an energy crisis in Europe, concerns surrounding energy flows between Russia and the European Union, particularly natural gas flows, and the possibility that there could be a shortage of energy during the winter months, and maybe even rationing, has raised concerns about a possible downturn in Europe. Both higher interest rates, concerns over growth, have driven risk currencies lower. As you can see from the chart, this is the FX performance tracker for the G10 currencies in the last 3 months. Every currency is trading lower against the US dollar, which has rallied to fresh 20-year highs against its trade-weighted basket in the last few weeks or so. Euro dollar is traded below parity. Some of the higher risk currencies, Australian dollar included, obviously sterling, New Zealand dollar, have suffered very sharp sell-offs in excess of 6%, 8% for the New Zealand dollar in the last few months or so, and are trading significantly lower year to date. And of course, the turmoil in UK financial markets has added to that volatility in the last few weeks. The massive tax cuts that we saw following the budget announcement very much spooked investors and contributed to this risk-off mode, whilst sending sterling crashing to a record low, which of course we're going to cover in a few slides' time. The result of this risk-off mode, as we call it in foreign exchange markets, has been a sharp rally in the US dollar against pretty much every other currency in the world, with the exception of one or two of the Latin American currencies. The dollar index did rise to its strongest position since 2002, a rally of almost 20%, around about 18% year to date, which is quite an extraordinary move higher. What has driven this move? Well, as we said, a risk-off mode has prevailed in markets as investors fear the possibility of a recession, or at least a downturn in global growth, as interest rates go up sharply, as inflation remains sky high amid the energy crisis in Europe. The Federal Reserve, as I mentioned, has also remained very hawkish. It's raised interest rates more than any other central bank in the G10 since it began its hiking cycle in March. The September dot plot suggested that the Fed wasn't done just yet, that this was revised significantly higher, indicating at least another 75 basis point hike is on the way in November. Markets are now actually eyeing another 75 basis point hike in December. And also the US economy is holding up relatively well under the circumstances. Actually, the downturn there is probably likely to be relatively mild. The US economy is relatively isolated, so it's not necessarily impacted by the war between Russia and Ukraine and the fallout from that conflict. The labour market in the US continues to remain very strong, and that we think should continue to support domestic demand and prop up the US economy. So all in all, the dollar remains very strong. We think that a pullback, we still think that a pullback in the dollar is on the way, although it's likely that that's going to be a more shallow rebound in risk sentiment than we had expected, and obviously it's taken a lot longer for that reversal to come. The result, as we said, has been a sell-off in risk currencies, not just in the G10, but among emerging markets. Actually, an interesting trend that we've seen since, well, the past 12 months, only since the beginning of the year, has been an outperformance, actually, in emerging market currencies relative to many of the majors, particularly some of the higher risk major currencies, including the Australian dollar. This chart you can see is a comparison between the MSCI Emerging Market Currency Index, that's the darker blue line, relative to an inverse of the US dollar index. The dollar index compares the US dollar against a basket of 7 of the major currencies, euro, sterling, yen, for instance. You can see in the past year, these emerging market currencies have sold off, but nowhere near to the extent that the major currencies have, which is an interesting development, and one that is not particularly usual in a period where we're seeing aggressive hikes from the Federal Reserve. Usually when we see aggressive tightening from the Fed or major central banks in general, generally we see emerging market currencies underperform, but they've performed better. We think that that's, first of all, due to the very aggressive tightening cycle conducted by these emerging market central banks, which have actually, not only do they raise rates sooner than the major central banks, but they've also done it more aggressively. Well, commodity prices, for the most part, have remained high. They have eased since June, but remain high relative to previous years, which is as a net positive for most of these emerging markets. As a result of this, the heightened uncertainty that we're seeing in markets, we have seen, as I mentioned, a jump in volatility levels among many of the major currencies. The Deutsche Bank FX Volatility Index, which is sort of a broad measure of volatility among some of the major currencies, that's jumped to its highest level since July 2020, i.e. right after the peak of the COVID-19 panic. If we look at sterling and the euro, actually volatility levels there have jumped to multi-year highs. For sterling, the 6-month implied volatility has increased to its highest level since 2009, and of course just after the sort of peak of the global financial crisis, in excess of levels that we saw following both Brexit and the COVID-19 pandemic, which is quite remarkable. Similarly for the euro, we're looking at levels of volatility from 2012, i.e. the European debt crisis. So clearly markets are concerned that significant swings in both currencies, and indeed many of the major currencies, is likely in the next few months. We're seeing a similar trend among a handful of emerging market currencies, the Chinese yuan, for instance. 1 month implied volatility there is now higher than the peak of the pandemic, amid concerns surrounding ongoing zero COVID policies, a crisis in the Chinese housing market, and a general downturn in economic data there. So overall, a very volatile period in markets, lots of uncertainties, downside risks to global growth. That's fueling this dollar rally and leading to high levels of volatility across the board. Among the central banks, most major central banks are still raising interest rates and raising rates at a very aggressive pace, which presents still presents a significant uncertainty for the foreign exchange market. For the most part, inflation continues to run well above target. In fact, in every G10 economy, we're seeing an inflation overshoot and limited signs that we may have had a peak in price growth. So central banks continue to hike aggressively. The Fed, as we said, is leading the way. It's raised rates by 300 basis points since March, which is more than any other central bank. And I think in the last 12 months, only the Bank of Canada and perhaps the Reserve Bank of New Zealand have raised rates as much as the Federal Reserve has. Another 75 basis point hike is likely on the way in November, potentially another one in December. That we'll see how upcoming US data performs. For the most part, most of the other central banks in the G10 are playing catch up a little bit with the Federal Reserve, notably the European Central Bank, which delayed the beginning of its hiking cycle. But they're very much in hiking mode now. We expect a 75 basis point hike from them in October, with tightening actually, we think, to continue deeper into 2023 in Europe than what we're likely to see in the US, which does present, we think, some upside to euro dollar. Most other central banks in G10 are following suit. Obviously one potential exception, one exception is the Bank of Japan, which has not raised rates at all during the current inflationary period. And that's led to a significant underperformance in the Japanese yen. The yen would ordinarily rally with the dollar and the Swiss franc during periods of market uncertainty, but this ultra dovish stance from the Bank of Japan means that it's fallen well behind and has actually been the worst performing currency in the G10 since the beginning of the year. We are, having said this, we are beginning to see some signs that an easing in the tightening cycle may be on the way. In fact, it was the Reserve Bank of Australia that earlier this month, potentially the end of last month, at least a few weeks ago at any rate, was the first central bank in the G10 to revert to what we call a standard interest rate hike of 25 basis points. The market expected a 50 basis point move. So we are beginning to see some signs that some of these central banks are taking their foot off the pedal slightly, but there's still some way to go before we reach a level that these major central banks stop their hiking cycle entirely. That is particularly evident in the US, that the Federal Reserve has shown no signs that it will be pivoting just yet. It raised rates by another 75 basis points in September. Headline inflation has shown some tentative signs that it may have already peaked, although it's continued to surprise to the upside. The core level of inflation, though, that has continued to march to fresh highs, up to 6.6%, which is the highest level in 40 years. So Fed members have indicated that they'll need to continue raising rates. There's no signs yet of a sustained move to this 2% inflation target. The dot plot, as I said, was revised upwards in September. Fed members have been very hawkish since then, and markets are more convinced than they have been that another 75 basis point hike is coming in November. In fact, markets are now pricing at around about 140, maybe slightly more than 140 basis points by year end. So they see a reasonable chance that we could get back-to-back 75 basis point hikes through the end of the year. I would say that upcoming inflation data between now and December, upcoming non-farm payrolls reports will both be very important and very key to deciding that the pace or the magnitude of the hike in December. Should we get another 75 basis point hike there, then another fresh bout of strength in the US dollar going into year end is possible. But if they revert to a 50 basis point hike, which we think of the two is probably more likely, then that provides a bit of room for some downside in the dollar, given this elevated market pricing. This is essentially a visual representation of what I've just been talking about. This shows the changes we've seen, base rate changes from the G10 central banks. The darker shaded areas, the basis points we've seen in the past 1 year, and the blue, lighter blue shaded area. This represents what the market is pricing in between now and the end of the year. So you can clearly see, with the exception of the Bank of Japan, that every other central bank in the G10 has raised rates aggressively, with some more to come before year end. Actually, of the 9, excluding the Bank of Japan, the market expectations are around the lowest for the Reserve Bank of Australia, following their dovish shift at the October meeting, in which they raised rates by just 25 basis points. That actually spooked markets globally and caused a dialing back of expectations for rate hikes across the board. There is now general expectation that we could start seeing some of the other central banks in the G10 follow suit by signalling that perhaps these non-standard jumbo rate hikes are perhaps not needed as we enter into the end of this year and going into 2023. But I mean, we still think that rate hikes are still warranted in most instances. We continue to see a massive inflation overshoot in most, in fact, overshoot in all G10 economies, significant overshoots in most instances. particularly in the likes of the Eurozone, the UK, for instance, even still in the US, where inflation is more than 6% above the Fed's target. We have, as I said, begun to see tentative signs of a peak in headline inflation in the likes of the US, Canada, but that has not been the case everywhere else. So good chance we could see this hiking cycle extend into 2023 for most of these central banks. The currencies whereby their central banks extend their tightening deeper into 2023, we think are likely to outperform in the next sort of 6 months or so. I think sterling could well be one of those whereby, and we'll talk about this in a few slides, market is now increasingly confident that the Bank of England will have to raise rates very aggressively, certainly in the first half of next year, which could provide a bit of support for the pound. Lastly, before we go into sterling, talk about a few of the risks, or sort of recap some of the risks that we've seen, we've talked about, that we're seeing in markets at the moment. We've talked about inflation rates, which remain sky high, well above target in most instances. Interest rates globally have risen very sharply. There's concerns around an energy shortage in Europe, given the sanctions placed on Russia and the indefinite closure of the Nord Stream 1 pipeline. China as well, there is a general expectation that growth in China is set to slow quite sharply this year amid the lockdowns, housing crisis. Having said that, we do think that these downturns, while inevitable at this stage, we think these downturns and these recessions will be relatively mild. We continue to see strong labour markets support domestic demand for the most part. That is evident in Australia. It's evident in many other of the major economies. So we think that these recessions will be relatively mild, but there are still some significant downside risks. I would say the energy shortage in Europe, potential energy shortage in Europe, is probably top of that list. We would say that a shortage of energy is unlikely, but if it was to come to pass, that would be a significant downside, not just to the European economy, but to the global economy. Very briefly, we've seen this uncertainty filter its way through to euro dollar. I'm not going to go into this in too much detail, as we really want to talk about sterling, but we have seen some weakness in European currencies in general amid this risk of an energy shortage in Europe. As I said, we are hopeful that rationing will be avoided. The EU has made good strides in building up its natural gas storage, which we think will last during the winter months. But a colder than usual winter, the inability in order to lower demand among European nations does present a risk, possible shortages and energy rationing. The IMF is penciling a 2 to 3% drop in EU GDP under a worst case scenario. So while we're optimistic, this is certainly something that we'll be keeping close tabs on and could present a very significant risk to the global economy. And as you can see, I mean, data has represented these downside risks. That the business activity PMIs of the major economic areas have deteriorated. We're now looking at around about the level of 50 in most of the composite indices, which is around about flat growth. So nothing to worry about just yet. We're not seeing significant recessions so far, but it is the fear of what's to come, and the fear that we will see contractions in most economies as we enter into the winter months. But we're going to move on now and talk about sterling, and particularly how the UK or UK financial markets in general have reacted to the recent budget announcement from the UK government. And one of the main news stories, of course, that we've seen in the foreign exchange markets in general in the past few weeks has been the turmoil in UK financial markets, the sell-off in sterling in particular, in response to this budget announcement, mini budget, as it was called, although it turned out in the end to be not such a mini budget. In short, the government unveiled significant tax cuts, went above and beyond what was expected by markets, but provided no detail on how these would be funded and how it would impact the economy. There were no independent forecasts, which are usually released by the Office of Budget Responsibility. We are still yet to get those forecasts. They're due out in another couple of weeks. But the market was concerned about the impact of potentially increased borrowing, unfunded tax cuts, and the possibility that these measures could fuel inflation in the next sort of 12 months or so. All that combined to trigger a sharp sell-off in sterling, which collapsed to a record low against the US dollar at one stage. Bond markets in the UK also went into a bit of turmoil. Gilt yields, the yield on the UK government bonds spiked and rose to multi-year highs. And in general, the financial markets, volatility in financial markets was heightened as a result of this announcement. So what was announced? Well, I mean, the main sort of headlines coming out of the budget were there would be, first of all, a cut to the basic level of income tax that was set to, at least to be lowered from 20% to 19%. The 45% tax bracket, which is the top tier tax bracket for the highest earners, that was ditched. It says on this slide, this has since been reversed. Actually, most of these measures have since been reversed, and we'll talk about that in a few slides' time. But the national insurance hike, which came into force earlier this year in April, that was set to be reversed. Corporation tax, which was due to increase in April 2023, April next year, that was cancelled. Stamp duty rates were lowered, so the tax on purchasing housing for both new homeowners and existing homeowners. Energy bills were also frozen for both households and businesses. Households, it was due to last for 2 years. Businesses, there was support for energy bills over the next 6 months. So a lot was announced, and we'll talk in the next few slides about what is actually still remains in place out of these measures and how markets have reacted to both the budget itself and the U-turns that the UK government has made in the last few days. First of all, though, we're going to talk about what the budget or what markets initially perceived the budget to, or what kind of impact they perceived it to have on the UK economy, and the concern among investors in the immediate aftermath of the announcement was that the budget would have would have worsened the outlook for the UK economy. In the near term, the inflation peak was expected to be lower and the risk of recession was expected to be lower. And I think still is, given that the freeze to energy bills, which will now last at least 6 months, initially 2 years. The issue for markets initially was that they perceived the medium-term impact of the budget to be a negative one on the UK economy. We've listed here the main market concerns in the immediate aftermath of the budget. First of all, markets perceived that UK inflation would stay higher for longer due to the higher disposable income as a result of the tax cuts. Market was pricing in a delay to the Bank of England returning inflation back to its 2% target. So while we'd have a lower peak in price growth, higher price growth and above target price growth would be extended further into the future. As a consequence, the Bank of England was expected to raise interest rates more aggressively than it perhaps would have done prior to the budget. At one stage, the market was pricing in a 125 basis point rate hike from the Bank of England at its November meeting. Investors had actually expected the bank to announce an emergency interest rate hike in the day following the budget, potentially even intervening in the FX market in order to prop up the pound. That was not forthcoming, although the market continues to expect the Bank of England to announce a significant rate increase at its next meeting in a few weeks' time. Market is now pricing in around about 90 basis points in November, and a base rate of around about 5% by the middle of next year, which is down quite a lot. It was where the market was eyeing around about 6% by June 2023. So the market pricing for hikes has come off quite significantly. We'll get onto why that is in a little bit. And investors also thought that UK borrowing would rise, which was a particularly concerning development given what we've seen interest rates globally. We can see the chart on the right-hand side that shows the yield on 20-year gilts, the 20-year government bonds, that spiked in the immediate aftermath of the budget up to almost 5%, having started the year around about 1%, or a little higher than 1%. So borrowing costs were set to increase very sharply at a time when the UK government was set to borrow a significant amount more, and that wasn't what was expected. So significant concerns about the UK economy, and that growth would potentially take a hit from higher inflation, higher interest rates, and that the UK government would potentially be caught in a bit of a debt spiral. And we did see a handful, a couple at least, of rating agencies revise their outlook for the UK economy lower as a result of this budget. As I'm sure you would have seen, though, we have seen some stability in sterling and quite a quick recovery in the pound since the worst of the downturn. Actually, the initial recovery in the day or so following the sharp sell-off, we think was driven largely by expectations that the Bank of England would step in either by raising interest rates or by direct FX intervention. Actually, neither of those came to pass, and neither were actually particularly likely. The problem with direct FX intervention is that the Bank of England's reserves are very low. They're never usually needed, as months worth of import cover is less than 2 months, which is well below sufficient levels in order to intervene in FX. So there's no intervention, and there was no emergency rate hike. Actually, the impact of a rate hike would likely be very temporary on the currency, so the Bank of England refrained from doing so. What it did do, though, it did intervene in fixed income markets in order to try and prevent another sharp move higher in UK yields. It announced that it would purchase unlimited amounts of government bonds through to the 14th of October using its reserves. And so slightly different from quantitative easing, where the bank effectively printed money in order to purchase bonds. So this did help stabilize things in fixed income markets. Yields were able to stabilize, and the situation generally among financial markets in the UK was calmed. The issue, though, was that, of course, this bond buying couldn't go on forever. There's a very limited amount of bonds that they could purchase, particularly as they were using their reserves rather than printing money, which would have been inflationary. So there were concerns on Thursday when Governor Bailey announced that the programme would end as planned on Friday. There were concerns that this week we could see another fresh move higher in yields and a sell-off in bonds. But as we've mentioned here, we have had quite an unprecedented U-turn in policy from the UK government in the last few days, which means that this intervention hasn't been required. And we're going to get onto that into the next slide as to the main reason as to why we have seen this recovery in sterling, which in the last few days is been one of the best performing currencies. In fact, obviously, since the peak of the downturn, has been the best performing currency in the G10, and is now back roughly trading where it was before the budget against the US dollar. We've mentioned the Bank of England intervention that has partly helped, but the main reason for this recovery has been the significant and unprecedented U-turn on policy that we have seen from the UK government. That initially began with a ditching of the 45p top level of income tax. That was the first thing to go. I believe that was a sort of early last week. I might be wrong. That was abandoned. Actually, we saw that as largely a symbolic move. The top tier tax bracket only accounted for 4% of the total tax costs of the budget. So actually had relatively limited impact on overall levels of borrowing, for instance. But we continue to see pressure on the UK government and Prime Minister Liz Truss to do more. Of course, pressure from the media, pressure from the UK electorate, but predominantly really pressure from UK financial markets. As I said, there were the concerns that we could see another rout in UK bond markets had these measures not been unwound. We finally saw the Prime Minister cave on Friday of last week. That began, I should say, with the sacking of Chancellor Kwasi Kwarteng. It was actually, I think it was the second shortest stay as UK Chancellor in history. So he was replaced by Jeremy Hunt, who is seen as a more orthodox, experienced figure within the UK government. Has previously held a number of other cabinet positions. His appointment, particularly the announcements that he's unveiled in the last few days, has calmed markets. What else have we seen scrapped? Well, we've seen the basic tax rate, which was, I said, was set to be lowered to 19% from 20%. That has been scrapped. As I said, the 45p tax bracket has also been ditched. The corporation tax increase, which was set to increase from 19% to 25% in April of next year, that has also been cancelled. The only two significant policy changes that remain, or at least the two tax cuts that remain, are the increase to national insurance, or the reverse to the increase in national insurance, and the lowering of stamp duty. That said, the bulk of these measures have now gone. By our calculations, around 80% of the tax cuts announced in the budget have now been reversed, which has helped calm investors, calm the market, supported the pound, which, as I said, is, I think now, as of yesterday, was back trading at higher levels than it was at the budget announcement, or pre the budget announcement. We also had news on the energy bill freeze, which will now actually only run until April. That had previously been set to run for 2 years, but beyond April, this program will be reviewed and will be targeted towards those in most of need of the funding. Mostly good news for the pound. The tax cuts were a significant concern for markets. The one thing I would say is that the energy bill freeze, which will now only run to April, that may be a little bit of concern for investors. The increase in energy bills is a problem for economies globally, particularly in the UK. The average household energy bill is currently frozen at £2,500 for the average household. That is set, or was set, to increase to £6,500 in April. So beyond April, there is a concern that certainly next winter we could see a bit of a mini crisis whereby energy bills are significantly higher than they would otherwise have been. So that could potentially cap optimism towards sterling, potentially as we enter into next year. But we'll be keeping very much a close tab on that. What does this big policy reversal mean for sterling? Well, as I said, clearly we've seen a pretty strong recovery rally in the pound. Bond yields have stabilised, although we've not necessarily seen a sharp drop in yields or anything like that. But at least it has stemmed the rout in bond markets as well as supporting the pound. We are clearly much more optimistic towards sterling now than we were following the budget announcement. In a couple of days after the budget, we had revised our sterling forecasts significantly lower over our forecast horizon. But we will be in the next day or so revising them back up relatively sharply in response to this U-turn, albeit we don't think that the pound will end our forecast horizon higher than what we thought before the budget. We think that there are a number of risks that still remain to both the UK economy and UK financial markets. For one, political uncertainty has very much heightened as a result of this fiasco in UK government. Credibility has taken a massive hit as a result of firstly the budget itself and the U-turn that we've seen in the last few days. The future of Prime Minister Liz Truss is in serious doubt. We tend to look at bookmaker implied probabilities for political events, and they're placing around about a 70% implied probability that Truss will be gone before the end of the year. So there is a potential that we could get a bit of a messy period in UK politics as we get potentially yet another UK Prime Minister and another Tory leader at a time when the Tory party is doing particularly poorly in the polls and has very little public backing. Actually, they're currently polling at around about 24% in the latest poll of polls relative to the opposition Labour Party, which are more than double that. I think they're around 50% in the polls. So a significant drop-off we've seen in support for the government since early September. And Liz Truss looks to be running on borrowed time at the moment. It could be a matter of days or weeks before we start seeing attempts to force her out, or potentially, who knows, some sort of resignation. Government bonds and bond markets, as I said, also remain a bit of a concern. Bond yields remain sky high despite this U-turn. The 10-year yield is around about 4%, having been around about 3.3% prior to the budget and 1% at the beginning of the year. Damage has certainly already been done as a result of this budget announcement. Mortgage rates in the UK have increased sharply in the last few weeks or so and are likely to remain very high for a little while yet, given the uncertainty created by the budget, and still very high bond yields. This was one of the main concerns when the budget was initially announced, that actually the impact of higher mortgage rates and mortgage costs will more than offset any positive impacts from the tax cuts. That is still likely to be the case, at least for the near term. And also the Bank of England itself, we think it may be difficult for the MPC to meet the market's lofty expectations for interest rates in the next few months. We can get onto that into the next slide, actually. As I said, markets went into overdrive following the budget announcement, ramping up expectations in favour of Bank of England rate hikes. At one stage, the market was fully pricing in 125 basis point hike at the November meeting, and around about 230 or slightly more basis points of hikes by year end. That pricing has eased in the last few days, particularly following this U-turn. There is, though, a great deal of uncertainty as to what the BOE will do in the next few meetings. Markets are unclear as to the magnitude of the November rate hike. The Governor Bailey and Chief Economist Pill, among a number of other members, have suggested that a significant rate hike is coming, albeit that was before some of these U-turns. So there's very much a great deal of uncertainty. Markets at the moment are pricing in around about 90 basis points of hikes in November and 170 basis points by year end. We think that it may be difficult for these to be met. The Bank of England has a recent penchant of surprising to the downside. And we think it'll be very difficult for them to raise rates to as high as 5% next year, given the potential implications for both UK bond yields and the UK economy in general. We think that they may err on the side of caution, and that could potentially, we think, present a downside risk to sterling, even if the rates are raised deeper into next year than most of the Bank of England's peers. And so I'm going to briefly move on to what our expectations are for sterling against the Australian dollar before we have time for questions. Generally, we continue to hold a positive view on both sterling and the Aussie dollar against the US dollar, which is the currency by which we do most of our forecasts against. For starters, we think that the dollar is the US dollar, that is trading at very high levels. We think we'll see a correction once concerns surrounding recessions begin to abate. Once the Federal Reserve indicates it will be bringing its hiking cycle to a close, we think that we'll start seeing a bit of a retracement in the US dollar. But overall, we do think that the Australian dollar is better placed to pose or to place a more stronger rally against the US dollar than sterling. For starters, commodity prices remain high. They have eased in the last couple of months or so, but remain relatively elevated, and there are risks to another increase in commodity prices, in our opinion, which should support the Australian economy, given its high dependence on commodity production and most of its major peers. The Australian economy also appears to be holding up reasonably well. We have seen signs of a deterioration in some of the data. The PMIs, for instance, around about level of 50, representing flat growth. But we think there's a low risk of recession, no sign of a significant downturn in sight. As I mentioned earlier, the Australian labour market remains strong. Unemployment levels are very low. Job creation is pretty solid. We think that should continue to support household demand. In fact, we are seeing that in the latest consumer spending data. Retail sales has been positive, I think, in every month so far this year. So that, we think, should spur a bit of a rebound in the Aussie dollar from what are extraordinarily cheap levels. What we think that the sell-off has gone a little bit too far, and that a pretty meaningful rebound is on the way over our forecast horizon. And given the risks that we're seeing still from the budget in the UK, given the risks we talked about with the Bank of England, we think that that recovery rally in the Australian dollar will be slightly more meaningful than what we're likely to see with the pound. Having said that, risks do remain. I've mentioned both of these. I think these are probably the two most significant downside risks to the Australian dollar. First of all, growth in China is set to slow sharply this year. Authorities in China continue to persist with the zero COVID policy. The PBOC is continuing to ease policy aggressively. That we think increases uncertainty towards China. China's growth is set to slow, which is generally a negative for the Australian dollar, given the close trade relationships between the two countries. And as I said, the RBA has also been the first central bank to revert to a standard 25 basis point rate hike. So actually, we think that this means, particularly the latter of these two, means that perhaps the Aussie dollar won't rally quite as significantly as we believed prior to this latest central bank announcement, but we still think that it's trading at very undervalued levels, particularly against the US dollar. That's everything from me in terms of the main content. We'll now open it up to any questions that you do have. So if you do have any questions that you would like to ask, please feel free to pop them in the Q&A section within Zoom, and we'll get around to answering any questions that you do have.
Sensational. And thanks for that, Matt. Sensational slides. Question I've got here, central banks have been largely begging for support from governments for many years, and probably saw that during COVID, in hindsight, might have gone a little too hard with support for consumers. With central banks now expected to do the heavy lifting again with interest rates, do you foresee that there's risk of it going too far? And then on top of what we're seeing with energy prices, that interest rates going too high is going to push people into trouble with mortgages and businesses as well.
Yeah, absolutely. I think that's the delicate balancing acts that these central banks have at the moment. We're seeing that across the board, whereby there has been some hesitancy among some central banks. We saw that notably in the UK. Actually, the Bank of England earlier this year gave some very muddled communications, because on the one hand, it is trying to rein in multi-decade high levels of inflation, but on the other, there is a risk that if they go too far, they're potentially pushing their economies into recessions. Actually, our sort of view is that sort of mild recessions are not the end of the world, and actually mild recessions may be a good thing, because they may help bring down levels of price growth. So while there are some hesitancies among some policymakers with regards to raising rates, we think that they're likely to continue doing so and prioritize getting inflation down at all costs over potentially damaging growth. We've had communications from many central banks effectively saying that there is a bigger risk of doing less than there is of doing more, and their main goal is getting inflation back down to target, which they think should lead to a better outlook for economies over the sort of more medium term.
Sensational. And with that, we have seen over many years since the GFC build up in leverage in a lot of the major economies, public sector as well as private sector. Many strategies on the investment side have relied on close to zero interest rates. We did see a little bit of a let's say, panic in the UK market when it came to pension funds and rapidly rising yields. Do you see that as being resolved now, focusing on the pension fund industry in the UK? And do you see any other sort of vulnerabilities or weaknesses in the UK and Europe right now?
Yeah, I mean, I would say that we're not out of the woods just yet. I think that's probably the key takeaway from this U-turn, that while we have had some encouraging news in the last few days, while markets have calmed down slightly, bond yields still remain very high. We've not seen a significant retracement in those just yet, and I probably don't expect them to do so. Of course, as the government has argued, and as we would contest as well, I mean, part of this reason as to why we are seeing the concerns in markets, particularly in the UK, is also to do with higher interest rates globally. That has been driving up bond yields, been driving up borrowing costs for some time. So this budget announcement has merely exacerbated matters, but the problem and the issue has not gone away. The fact is that borrowing costs have risen too aggressively and too sharply since the beginning of the year. Mortgage rates have gone up significantly, borrowing costs for businesses have gone up sharply. So that does present a significant risk, and that's not going to evaporate just because we've seen a few of these U-turns from the UK government. We have had a question in the Q&A chat as well. I mean, the question is regarding our sterling Australian dollar forecast, and do you publish these forecasts? Yeah, these can be made available by our sales and dealing teams. I would say that we haven't yet finalised our latest forecasts for sterling. We're hoping to do that in the next day or so. We may need to wait for markets to calm down a little bit before we do so. But as I said earlier, when we're still penciling in a slightly stronger Australian dollar against sterling, albeit those risks that I mentioned to the Australian dollar means that it may not be quite as significant as a rally as we thought previously.
Importantly, always important to note that forecasts are often revised, and forecasts have been ratcheted down quite a lot throughout this year. If you look at the Aussie US in particular, most of the major banks in Australia had a forecast of the Aussie US at 80 cents by the end of this year, and we've seen most have revised down drastically. With looking at the CBA in particular, they think Aussie US will get down to as low as 62. So we have seen that the forecasters have been very busy this year in updating their views, because we've had a lot of new information coming at us thick and fast. And I think what's happening in the UK example is perfect in that we constantly see that on the fiscal side, with the government continuously changing their policy, it does create a lot of uncertainty for markets, and what that uncertainty means to the price action, seeing the markets adjust very quickly over a short period of time.
Yeah, and I would say this year, 2022, has probably been the most difficult year for forecasting currencies since I started in FX 8 years ago. I think this has been the most challenging by quite a long way, even more so than during COVID.
Sensational. Well, looks like we'll wrap it up there. Thank you all for joining. We'll certainly be circulating the recording of this around, so you can share it with your friends or colleagues or clients. And yeah, thank you all for joining.
Cheers, everyone. Thank you.
Thanks.